please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to a fresh new edition of Taking Stock. This is the show where we look back and we look ahead. We decode what were the big factors which played in the minds of the market. And of course, we also try and tell you what to expect as the coming week starts. I am Prashant Nair. With me is my colleague Ekta Batra. Ekta, as always, we try to sort of look back in terms of what were the highlights. So what stood out?
Well, yes, I'll start with actually Friday's trading session where the Nifty largely, you have to say, consolidated at those levels of around 10,800. So for today, that's exactly what we saw. There was an underperformance that we saw from the Nifty Bank as well as from the mid-cap index. Now, if you're talking about the two key stocks within the IT space, it was TCS and Infosys, which really helped and propelled the market in today's trade, besides all of the interest that we've seen in the pharmaceutical stocks continuing. Now, in terms of the week-to-date basis, the Nifty outperformed the mid-cap index on a tad basis. So it was up around 0.5% as compared to the mid-cap index, which was just about flat with a little bit of a shade of red. Now, the pharma index continued to shine this week. So that one is gained around 8% on a week-to-date basis. Dr. Reddy, Cipla, Sun, all of these stocks gained. And besides that, it was Reliance Industries, which also gained around 3% in terms of market cap for the week. Other stocks in focus which underperformed included Tata Steel, Vedanta, ONGC, IOC. And from the broader markets, a couple of these beaten down counters, Vakrangi, PC Jewelers, Granules, all of them saw some amount of buying. So be careful on a couple of those names, and something like Punj Lloyd, which was down 10%. But Prashant, going forward next week, what are the triggers that we have lined up?
I mean, you know, same time last week, it was kind of a good situation, and we always start top down. So you had dollar, which was starting to decline a little bit. You had global equity markets, especially the US stock indices, which were all looking pretty good, and oil was actually headed south. So, I mean, you couldn't have asked for a better setup. But as we wrap up this week, it's gotten a little more maybe a little not so clear. So the dollar, for example, is now looking very bid. I mean, especially against emerging market and Asian emerging market currencies. And that may have something to do with essentially, you know, the Fed. It was there was a bit of a hawkish surprise, but, you know, the reaction in the dollar right after that was not as if the dollar was bid higher at all. But, I mean, with the ECB, which has essentially been read as pretty dovish, I think the dollar is being bid once again. By the way, the DXY, the index itself, the dollar index itself, is poised to post what is called a bullish outside week. I mean, in technical parlance, that is actually pretty, it's a bullish indicator. So keep an eye out on that. A stronger dollar, a dollar headed higher, isn't always, I mean, mostly isn't good news for emerging markets. Come to indices, the US stock indices, no problem. They are grinding higher, they're pushing higher. So the S&P 500 is getting to a pivotal resistance close to about 2,802. You know, you read what global technicians, etc., are saying about this. They're seeing the S&P in the 3,000 plus kind of levels once this sort of target gets taken out. We've also been pointing out that other big indices, the semiconductor index, for example, the Nasdaq, they've all taken out important technical levels over the last many weeks or so. So that is as far as global stock indices go. The other big variable for India is oil, and oil stays ranged. The coming week, of course, is big. Friday and Saturday, that is next Friday and Saturday, there is the OPEC meeting. I mean, I guess we can expect Trump to continue to troll OPEC into doing something, but as we've seen earlier as well. But I think it will be important if OPEC decides to sort of, you know, let loose on production a little bit. It'll end the policy of tight production quotas, which has been in effect for the last 18 months or so, and that may push oil lower. So that is oil. Coming to India here, we've had a pretty flat week so far. The focus will remain on sort of borrowing costs and yields. I mean, the sense from that market is that the pressure on yields may remain for the foreseeable future. From the rupee market, the risk reward for going long the rupee isn't really there, and hence, I mean, the picture for the stock market also remains, you know, in a way unclear. We've had, remember, for small caps and mid caps, a pretty sharp recovery from the lows of late last week. Is that over? I mean, looking at Friday's session, it might look like that, but you never know. Look at flows as well. That's the last graphic before we bring on our guest. we've seen 5 weeks of outflows out of global emerging market funds. This is EPFR data. So this kind of tells you the broad thrust of the direction in which flows are going. Where is the money going? It's coming out of global emerging market funds, but it is going into, the equity money, at least, it's going into US ETFs. So, with that not so brief comment, let's bring in our guest.
Yes, absolutely. Joining us on the show this evening to discuss all of what we can expect for next week and how this week panned out is MD and CEO of Bank of Baroda Capital Markets, Ratnesh Kumar. Ratnesh, hi. Thank you very much for joining in on the show. So overall, we are at 10,800 for the Nifty. There's been a tad bit of recovery, but where do you probably see the Nifty go from here on? Is it probably going to consolidate, or are we going to go back to 11,000?
Yes, one correction. It's BOB Capital Markets, not Bank of Baroda Capital Markets. And one other really important thing also which happened last week, this week actually, as it is ending, is the start of the World Cup football. So hopefully, that gets the market going in a better mood. But some of the opening comments that you all had made, actually, if you stretch it for the rest of the year, there are going to be some really solid sort of trends which will run through the year. It won't be just for the last week and the next week, which is that US dollar strength, greater flows into the US and out of the emerging markets. And actually, we're looking at equity flows. What is in fact more relevant for the currencies are the debt flows. The debt flows, in terms of the foreign flows out of the emerging markets, are much more larger. And that is having an impact on the currency. So I think those trends will continue. But to start with, on a positive note, I do remember seeing some pretty comprehensive analysis over the last 100, 200 years. Is the U.S. Fed in the initial part of the rate hikes tightening period, stock markets actually do well, and the reason being that those initial steps of tightening rate hikes are a response to growth coming back, and equities like growth. So I think, to my mind, we are in early stages of rate hikes, especially in India, which is also a reflection of growth coming back, and that is what my focus will be. I think if I was to set out the trend for rest of 2018, rates going higher in the US, rates going higher even in India. Probably there's one more rate hike remaining. Maybe it happens in August or in October MPC. But all of that is going to be a reflection of growth going higher and inflation going higher. And a little bit of inflation is actually not too bad for businesses. And those will be the underlying trends, I think, for India as well for the rest of the year.
Do you see more than one more rate hike by the RBI?
No, I think one is what we expect.
So it's not a deeper rate hike cycle?
Not this year. And what will also happen is that towards the end of this calendar year, early next year, there is going to be some impact from the political, noise which will be there. And so to that extent, one is what we foresee right now.
Where does it leave us in terms of stock markets, Ratnesh, in the near term?
Well, I think it is going to be a challenging period for the market if I look at the next 9 to 12 months. Simply because of the fact of the news flow that you have from the macro end. Naturally, we have come a long way in terms of domestic savings going into equities, but as a stock of money in the market, foreign money is still 70–75% of the institutional money. And what we have seen is, naturally, over the last 1 or 2 years, domestic flows substantially overtake the foreign flows, but foreign flows are still big, and it has an impact. And I think for the rest of the year, for India as well as all the emerging markets, getting back into the positive territory as far as the foreign flows is concerned is going to remain a big challenge in the environment that we have. So that is what is going to be one major driving factor, in addition to political noise which will come maybe 9 months, 12 months later. Ironically, this is going to be happening at a point in time when actually companies and businesses are going to be doing much better over the next 9–12 months than they have done in the last 9–12 months. Economy is going to be on a higher growth path. Businesses and sectors, some of the key ones, will be on a higher growth path. But stock market will find performance challenging during this period. simply because it is very tough to expand your valuations when the flows, at least one part of the flows, are challenged in terms of foreign flows and rates are going up.
Jubilant food box is at a fresh high, and you coincidentally also spoke about the World Cup. Basically, this whole urban consumption theme that is playing out very strongly in the markets, how should one probably take advantage of that?
I think it is going to be a sustained theme for not this year, not 1 year. Elections will come and go. I think the urbanization, increasing urbanization, and to that extent increasing urban consumption, that is going to be a sustained trend for companies and the businesses which are in that space. From the investor's point of view, it is more about getting in the right companies at the right time, so that they're not like they don't suffer from any kind of a overvaluation spike, etc. But the broader question that you asked about consumption, especially urban consumption, even when there is growth in rural consumption, there is still pickup in urban consumption. So that is going to be a sustained theme, not just for one company, but all the companies which are playing through in that, be it in the housing space, be it in the restaurant space. And I think the key there is to look for plays which are not over-leveraged kind of businesses. Businesses which feed on consumption rather than asset building. I think that is what I would focus as a theme there.
So in terms of so consumption would be, I guess, one of your top bets broadly,
Well, right now at this point in time, I think looking a couple of years, 1 to 2 year kind of time horizon, having a sort of election in the middle of all of that, my play would still be for a domestic recovery, strengthening and broadening. And so playing on the domestic recovery, even on the investment part of it, gradual recovery is already being seen. And as dark as it looks in terms of the investment cycle and the lack of credit expansion which might have been there in that space, in the industrial space, I think a lot of the problems are coming to a head now, and with some resolutions taking shape in the IBC process and businesses seeing growth back, I think the broadest theme that one needs to play in for the next 1 to 2 years, to my mind, is the domestic recovery.
And domestic investment recovery.
Domestic recovery, both consumption recovery and investment recovery. Naturally, investment is coming off a rock bottom, so the recovery there is...
Because, I mean, when you talk about consumption, there is no problem there. I mean, look at lever multiples or I mean, Jubilant Food, for example. So the one where there is potentially upside is the investment place. Investment
recovery. So what you are actually already seeing is some of the sectors, steel, cement, construction, autos, you are seeing good growth coming back. And to my mind, this is just the early phase of that growth recovery, because you've just seen 1 or 2 quarters of economic growth. Some of that could be also base effect. So the real growth recovery is ahead, because impact of demonetization, GST, all of that has been sort of now built in.
Could one look at corporate banks as a play to play that theme?
Corporate banks will be still a little early.
Okay.
I think you have other sectors that you have where that growth recovery is already visible, as I mentioned, in steel, in cement, in autos, auto ancillaries. Consumption was never too far down, so it is not coming off that much of a bottom. But these other areas is what I think you need to focus on. Housing, for example, housing is also going to grow as part of the domestic recovery.
This whole pharmaceutical rally that we've seen, are you convinced about, say, a sustainable recovery in these stocks?
So I have limited understanding of pharmaceuticals, I think, but jokes apart, I think pharmaceutical, most of the play is on the US news flow. And, stocks may perform from time to time, but I think that doesn't fit the overall domestic recovery theme that I want to play over the next 1 to 2 years. So I would leave that to some of the sort of more of experts on the pharmaceutical side, but my focus is actually playing more on the domestic recovery side, and there you'll get more delta. Compared to a pharmaceutical.
Linked to that, I mean, the other part of pharmaceuticals would be healthcare, hospitals, diagnostics. we've seen some amount of interest coming back within that. It's parallel to say that we've seen some amount of interest coming back within that. It's parallel to say that urban consumption theme that you're talking about. People want better hospitals, people want better sort of medical care as well. Would that be something that you would look at, say, from a domestic recovery point of view?
So healthcare is actually, it is going to be probably more of a secular growth trend than urban consumption, because of the fact that how far low we are in terms of the healthcare existing facilities and the requirements which are there. The challenge that equity investors have faced in the healthcare space is actually how to invest where the model is not asset heavy or over leveraged. And so what you've seen in healthcare is some of the great stories actually fizzle out simply because of being over heavy on the asset and over leveraged. So if we can find models which are not excessively leveraged, so you have diagnostics, for example, they are somewhat more asset light models. I think those kind of businesses have great possibility of returns for equity investors. Growth is going to be there. The question is, can equity investors always identify the risk points in an over-leveraged or excessively leveraged part of the business, which is the hospitals?
Sure.
That is always going to be a challenge. Otherwise, business, if one can find in healthcare, lower asset cost model, even in hospitals or in other sort of ancillary services, medical services, I think that is going to be a winner.
Long runway there. I'm going to push you to just before we wrap up, 3 top bets, absolute return top ideas from you.
So stocks, I don't sort of take names, but essentially, I would because
we have the themes already. So which is the domestic investment recovery themes.
I think domestic within domestic recovery, my top themes will be in autos and in construction.
Autos, OEMs or ancillarities?
Both. Autos, OEM, ancillary. Ancillaries, in fact, some of them have got beaten down with the value emerging in this mid-cap correction which has happened, as well as construction. You're seeing good activity happening in housing as well as infrastructure.
All right, Ratnesh, we're going to leave it on that note. Always a pleasure. Thank you very much for joining in with your views. We need to take a break now, but before that, let's get into market opinion. We've heard through the week, and when we come back, Ashwini Gujral will be with us to tell us his picks for next week. Stay tuned.
I think the pessimism around India is probably a little bit overdone now. Within the market, there's been a big dispersion in performance in India, with a few of the tech companies doing well, some of the consumer staples, the more defensive companies doing well, and cyclicals generally struggling. And perhaps that sort of pessimism starts to bring us into a bit of a buying opportunity in an economy that maybe is not as robust as it has been for the last couple of years, but is still a pretty strong growing economy. India's moving up the list. So I am reluctant to be buying into emerging market basket as a whole. I do think there's still a very wide range of fundamentals there.
The pain on the small and mid cap is still there. Clearly, there has been fair amount of immature or uninformed money which has gone into lots of small and mid-cap stocks in chase of return, and their selling is still continuing. We believe quality mid-caps will start bottoming out over next 30-40 days.
Over the next 1 or 2 quarters, you will have a significant write back on all these banks, because a lot of this money was not bad. This is asset backed. This is, real hard collateral back. So you will have the provisions which were being made, you will have that coming back. SBI has come and said that they will do 50,000 crore rupees of recovery in this year. Okay. Few days back, I read an article which says that Punjab National Bank aims to recover 20,000 crores in this year. So these are large numbers, I don't think these prices are factoring in that kind of recovery.
Well, Welcome back. You're still tuned into Taking Stock. We have Ashwini Gujral who's joining in now with his view on the technicals for next week. Ashwini, hi. Thanks very much for joining in. How would you assess this week as a whole, and what do you think will probably happen next week? What's the biggest trigger?
See, all of this year I've been saying that this is a sideways market where there is no follow through. So it's very clear that if you want to be long, you can't be long in the entire market. If you want to be short, you can't be short on the entire market. To be long, stay with those stocks which keep making new highs: HUL, TCS, Infosys, Avenue Supermart, Bajaj Finance, etc. On the short side, maybe metals, PSU banks, those sort of plays. But as we saw today, that despite a breakdown, we couldn't sustain, and 4 or 5 stocks pulled the index back. So this sort of choppy action will continue till we get some big trigger, some big election result, or state elections or global news. Till that time, we are just biding time.
Ashwini, mid caps and small caps saw this sustained recovery from late last week, the lows of late last week. It ran till about Wednesday or so, and then it started petering out. Friday, for example, we completely gave up that momentum. So are we looking good there, or are we again looking a little dicey? Mid caps and small caps.
See, again, unlikely they will go to their previous lows, but choppy action. They had 7-8 days of rally. Now they have 7-8 days of decline. I don't think much should be read into this sort of movement. Basically, till we are between 10,000 and 11,000. It's just a sideways consolidation given the large rally we had last year.
Okay, well, the sector of the week, it seems, is the pharmaceutical stocks. Is it good for more, Ashwini?
See, the strength of this rally tells you that, how far it can go. Because this is not correcting despite market conditions, despite having gone up a whole lot. So the moment you get a 2-3 day type pullback, the chances are very strong buying will come in, because in the first rally most people are not able to participate. I think the way it's moving, there is serious reallocation of institutions, etc., which is happening right now.
Ashwini, your trades for the coming week?
Well, for Monday, Infosys is a buy with a stop of 1260, target of 1320. Hindustan Unilever is a buy with stop of 1610, target of 1665, and Oro Pharma is a buy with a stop of 600, target of 635.
Okay, all right, Ashwini, we're going to wrap it up on that note. Thanks very much for joining in, and with that, it's a wrap on Taking Stock. Thanks for watching. Have a great weekend.